Be Wealthy and Smart, episode 1155.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the Consumer Price Index coming in a little hotter than was expected yesterday. What does that mean, and how are markets reacting to it? There's some really interesting things going on that are a little more subtle than what you might have heard in the news. First of all, everyone is watching what is inflation doing and what are the numbers telling us, because markets are still unsure what the Fed's going to do this year as inflation seems to continue to moderate, but some are wary that a jump in inflation could surprise everyone, and that's a little bit of what happened yesterday. The problem is, if inflation is higher than what is expected, the Fed is going to be in a position where they have to raise interest rates or keep interest rates up longer than the market is pricing in right now. Higher interest rates would typically hurt growth stocks like technology, as higher interest rates make future profits appear less valuable in today's money. So far, quarterly profits have had some weakness and are set to fall 4.9% over last year. So what happened was the Consumer Price Index was up 5.6 year over year versus what was estimated at 5.5%. So just slightly stronger than what was expected. But markets sold off a bit at first and were a little concerned because the December report was also revised to show a slight gain in inflation instead of a decline in inflation. The Consumer Price Index rising 0.5% for the month translates into an annual gain of 6.4% inflation, which is slightly higher than economists' estimates of the basket of goods and services rising 0.4% in the month and 6.2% for the year. While the report was better than what some people were expecting, and some of those people were expecting much higher inflation, but at the same time, it's unlikely to cause the Fed to back off from its plan to tighten more. Mike Loengart, head of model portfolio construction at Morgan Stanley Global Investment, said while there were no major surprises in today's CPI reading, it is a reminder that while inflation has peaked, it could be a while before we see it moderate to normal levels. The question remains if inflation will be able to fall to the Fed's target levels with the labor market as tight as it currently is, he added. That could be the recipe for a soft landing, but it remains to be seen when the Fed will shift away from rate hikes and if the labor market will lose its resiliency. Now, what was not good is that Treasury yields moved higher, and the yield on the 6-month U.S. Treasury closed at 5.022%, which is above 5% for the first time since July of 2007. One of my favorite forecasters is Ned Davis Research, and he said he has less confidence in the prior view that the Treasury yield curve will steepen, and is now concerned that an alternative view is growing in likelihood as global growth accelerates. His chief strategist, Joseph Kalish, said he was laying out an alternative scenario to Ned Davis's base case to ponder the view contrary to our expectations to keep an open mind, and that there are at least 3 headwinds that are blowing in the face of higher bond prices and lower yields: tight labor markets, increased bond supply, and poor relative valuations. He said it's possible that bond investors have already seen a soft landing, which was in 2022, and now that housing activity is likely bottoming out, non-residential investment could also pick up on better consumer and business confidence and an improved outlook for global growth, and the economy could reaccelerate as recession talk dissipates, which sounds really good, but if you're anticipating that things are not going to get weaker, that means interest rates won't come down, which won't spur the economy further. So all this speculation about the second half of the year and whether we're going to have a soft landing or not, or whether we're going to have a deeper recession or not, is affecting markets today as markets look about 6 months in advance and try and anticipate the future. One of the ways they do that is by looking at interest rates. So to have short-term treasury bond rates spiking to the highest level since 2007, that's not a good indicator of lower rates going forward. But it's also maybe a short-term response to an inflation number, and we have to take it with a grain of salt. New York Federal Reserve President John Williams expressed confidence yesterday in the progress being made against inflation, though he said the central bank is not finished with raising interest rates. He said, when it comes to monetary policy, we must restore balance to the economy and bring inflation down to 2% on a sustained basis. He said, I am confident that the gears of monetary policy will continue to move in a way that will bring inflation down to 2%. We will stay the course until our job is done. He noted several factors that are complicating the inflation fight, such as rebounding economic growth in Europe and China, also progress that had been made in unclogging global supply chains has stagnated in recent months. He said services excluding food, energy, and shelter, or what he called super core inflation, also has stayed elevated. So our work is not yet done. Inflation is still well above our 2% target, and it is critically important that we reach that goal, Williams said. So of course, the Fed is steadfastly focused on their 2% inflation target, and that's what they're raising interest rates for, is to try to get inflation down to 2%. So we're still quite a ways above that, and that's why some people feel like we're not going to get relief in lower interest rates later this year because the Fed still has a ways to go to get inflation back to 2%. Now, the other thing to consider is that there's a delay. Famous economist Milton Friedman said it took 12 to 18 months before you got any effect on prices. And it's only been 11 months since the Fed began raising interest rates. So we really haven't had time for these interest rate hikes to really affect prices and really start to reduce inflation in the way that it should. If you followed me for any time or read either of my books, you know that I'm big on cycles. I proved in my books that cycles not only exist, but there's information that wealthy insiders keep to themselves. So when I hear someone actually reporting on cycles, I always like to share that information with you. Bank of America's Stephen Sutmeyer said the broader market action is something similar to what we've seen in previous bull markets. He said, we view the 1950 to 1966 market, the 1980 to 2000 market, and the 2013 to present market as secular bull markets for the S&P 500. Each of these bull markets had important 7-year lows, 1957, 1987, and 2020. The lows in 1960 and 1990 occurred exactly 36 months after the 1957 and 1987 lows, respectively. And the October 2022 low was 31 months after the March 2020 low. And of course, the S&P 500 is up 15% since reaching that low on October 12th of 2022. So that gives us more ammunition that the low in October of last year is likely the low. As I've mentioned before, there is a 10-year cycle or a decennial cycle where the second year of the decade is very often the low for the entire decade. It doesn't always hold true, but more often than not, it does. And it's quite possible that the low in October 2022 could be our low and we move higher from here, although I know there's still a lot of bears out there that believe that the markets are going to go lower. A lot of that is based on what inflation does, because what inflation does reflects what the Fed is going to do. If we have high inflation and it doesn't come down, then the Fed is going to either continue to raise interest rates or hold them higher longer. If, however, that lag time starts to work toward reducing inflation more than people expect, or we have a soft landing, or we have a bigger recession than is expected, any of those scenarios mean that interest rates are likely to come down, and the Fed may pause, stop raising rates altogether or actually have to cut rates in the second half of the year. This is the debate that's been going on, and I presented both sides to you today so you can see that on the one hand, we have inflation a little bit stronger yesterday than was expected, which caused interest rates in the short term to spike a little bit. However, the question remains, have interest rates been raised enough already that inflation is already in process of coming down and the Fed isn't going to have to raise interest rates as much as we had initially thought? I'll continue to report into you with this very interesting discussion. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. Many more than are available on Apple Podcasts, which only has my most recent 200. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.